Hey everyone, Eric Walters. I thought I would record this quarter's market outlook and share it with you ahead of time for our meeting, just to give those who are, interested in kind of looking at it and thinking about it a chance to look at it ahead of time. And for those that aren't that interested, you can just skip this. And when we meet, we'll focus on your financial plan and, maybe not this. And so I wanted to, kind of share our outlook. I'm calling it balancing a polarized world. And I think, given the current market environment, I think that's pretty accurate. So, first, of course, our mandatory disclosures. But here's the summary of what I want to go over. When I say a polarized world, on one hand, we have particularly wealthy consumers that are spending consistently and leading to increased consumer spending. Then we also see evidence of rising business investment that, usually bodes well for GDP. So if you were just to stop there, you'd say, oh, things look pretty good. However, as you know, there is a war going on. And that war is causing a very large surprise as Iran is fighting to control and stop all shipments through the Strait of Hormuz. This has already led to unprecedented increases in oil prices. Our elected leaders say, hopefully this will be over soon. But in the near term, this is leading to a lot of pressure on consumers and any sort of business that uses oil directly or an oil-derived product, such as chemicals. The other big theme is that what I would say is relentless artificial intelligence expansion. This is not just people, kind of messing around with it. This is across the economy in terms of investments in data centers, power generation. As I mentioned, of course, companies and individuals are using it, often leading to increases in productivity, but it's also creating uncertainty about employment. There's already been a number of layoffs that have occurred, and people have wondered, are those a result of companies implementing artificial intelligence? And we really don't know. In the last probably about 5 weeks, we've seen a notable pullback in the stock market prices of software companies as investors have grappled with this idea that many artificial intelligence tools now allow individuals with no coding experience to basically create software that in some cases large companies were paying millions of dollars per year for. There are some examples of companies that are simply bringing that in-house using, fairly affordable off-the-shelf artificial intelligence. Now, there is also, I think, an important realization that as more and more baby boomers retire, we do have a gap in workforce knowledge, workforce productivity, and the artificial intelligence tools could potentially offset that. So, where does that leave the market? I think the stock market will continue to vacillate between two diverging inputs. We've got, lower Federal Reserve rates. The Federal Reserve has lowered rates 3 times. We've got, kind of steady consumer spending and GDP inputs. That's positive. Of course, you've got a war in Iran. You've got the increasing price of oil, and you've also got the uncertainty around artificial intelligence. Will it go ahead and destroy lots of business models such as software, and or will it lead to large amounts of unemployment or just a big productivity boom? So, we're, kind of dealing with this. I think it is also important to point out, as I did earlier this year, that valuations for U.S. large cap, particularly technology companies, are extremely elevated. And historically, when you get an asset class that is that expensive, usually it does pretty poorly over the next 5 to 10 years. And that's a fairly easy call to make. The hard call to make is, when might that happen? We're not exactly sure. But for that reason, we are favoring rebalancing back to targets. We are favoring international stocks despite the concerns about the war. Um, and then also bonds are offering a kind of a nice yield here. And then diversifiers such as managed futures provide, I think, a real refuge in good and bad markets. So that's the overview. I'll share some additional charts here. One, let's talk about the war. This is kind of top of mind for a lot of people. when we look at how the stock market has performed in prior attacks, in prior wars, and prior armed conflicts, we can see, and this is through history going all the way back to the Pearl Harbor attack, we can see that usually the total drawdown can vacillate anywhere between a few percentage points up to, negative 20% with the Pearl Harbor attack, with the onset of the US joining World War II. On average, it's a fairly modest drawdown over the entire length of the conflict, only about 4.5%, with a median drawdown of only 3%. And then the days to recovery is anywhere between 18 and 39 days. Now, many are confused by this. Why would, a serious conflict have so little impact on the stock market? And the answer is that the stock market is focused on companies that are publicly traded on the stock market. And if you look at those companies on a global basis and ask how much of their revenue and their sales and their profitability will be negatively impacted by this particular armed conflict, we often can see the answer that, oh, right, companies in Australia, or the US or, Mexico or around the world may, of course, be impacted by things like higher oil prices. But in general, often kind of business goes on as usual. So that's the first lesson, just that armed conflict from a humanitarian and political standpoint is, very serious. But from an investment standpoint, I don't think we have to make large changes until we see something really unusual happen, like the outbreak of a world war. The other thing I'll point out is that when markets do have a drawdown within a year, it's usually common that the market finishes in a different place. And this chart shows in the red where the stock market, reached within the year in terms of its negative point for the year. And then the black or dark bar shows where the stock market ended. And you can see there's some really interesting examples. For example, in the mid 80s, this is, I believe, 86, at one point the market was down 34%. This is actually probably 1987 with the October crash, and the market ended positive. There's a number of years where the market was down during the year, somewhat, either single digits or even double digits, and then ended positive. And so, I think I like this chart. This is annual returns were positive in 35 or 46 years. So this is the resiliency of a well-diversified portfolio, and that even if markets were continue to go down in the near term as a result of the Iran conflict, history would say there's a very good chance we'll finish positive. Last year in 2025 was a great example of this. The market was certainly, very unhappy with President Trump tariffs and, kind of unexpected regime, to the point where markets were down almost 20% in early April, only to end the year quite positive. And so that's, I think, an important reminder. Now, it is important to point out that, I think the investors are rightly concerned about the price of oil. However, it's not just oil that's getting more expensive. This trend of electricity and energy getting more expensive has been going on for quite some time. So if you're a homeowner and you've been, kind of wondering about why does your electrical bill keep going up, you're not imagining things. It's gone up quite a lot. And this is from a number of different factors. Of course, demand. Of course, the cost of the inputs. In the United States and in most countries, we don't use oil for an input. In general, we use natural gas now. For some countries, it's coal, excuse me. But the cost of constructing power generation, kind of not only from the raw goods all the way through to the power generation plant to delivery has just gone up. So, the issues with the Strait of Hormuz is the near-term issue. Hopefully it'll be addressed soon. But this has, more notable implications for the U.S. economy longer term, particularly as demand for energy from artificial intelligence completely skyrockets. And that's what we've seen here, it's the last couple of years, the demand for energy and the cost to provide it as artificial intelligence just soaks up massive amounts of energy is quite sobering. Now, when we think about this kind of divergent outcomes, one I mentioned is that companies, seem to be on par to, do fairly well. And if you look at expectations of world publicly traded companies around the world. This is the Morgan Stanley Country Index, World Index. The 2026 earnings per share estimates are quite good. Now they're down slightly with the onset of the Iran war, but still, the dollar per share earnings are quite good. Now, many people focus on publicly traded companies as, kind of the most important input. However, it is important to point out that really what moves the US economy is actually non-publicly traded companies. So if you can see, the S&P 500 companies employ about 28 million people, and all of the private companies in the United States employ everybody else. And this is very common. Most companies are between 1 and 100 people. They employ over 80% of employees in the United States. So really what happens with these, smaller, even a medium-sized companies is really far more important than the employment picture at the S&P 500. And what we see when we look at the trend is these small companies, as denoted by the blue line, and medium companies, which is employed between 250 and 5,000 employees, recovered from COVID, but have been diverging. And so smaller companies and large companies have, kind of gone down in terms of their hiring recently. And there's a number of potential explanations for this. I think looking at from 2024 to the end of 2025, which is the last time we can get reliable data, certainly tariffs were on a lot of businesses' minds. And then also, the introduction of artificial intelligence may have led to them hiring, fewer employees. Now, we do see that medium-sized employees or medium-sized employers did increase, but there is, this kind of worrying trend of kind of what's happening with employment, and we'll have to wait and see where that goes. Now, as I mentioned, one of the reasons why the outlook for artificial intelligence isn't necessarily all bad is that we do have a large amount of baby boomers retiring. This chart shows in the blue line the labor force participation rate. This is, the number of people of working age, which is between 18 and 65, that are participating. And we can see the labor force participation rate has been trending down for quite some time. Now, you may not be surprised that this coincides with, new baby boomer retirees. And as that number continues to go up and up and up, we just literally have fewer people. The generation after the baby boomers, Gen X, is notably smaller than the baby boomers. And it's not until you look at the next generation, the millennials, that you get a large enough workforce. So really for the next 10 to 15 years, we're going to be short on kind of employees and workers in the US economy. This is one reason why President Trump kind of focus on, no immigration is controversial with economists because they would point out that when you remove workers from an economy, you generally increase the cost of each worker and you reduce output. If you add more and more people, it generally means they'll work for less. And in history would say GDP and output would go up quite a lot. So one reason I think why investors and employers are very interested in artificial intelligence is that it's possible that it could replace some of this loss of workers, and also many baby boomers are the most experienced and most knowledgeable, and could artificial intelligence kind of advanced capabilities help with that? It's very possible it will. Now, it's also possible that artificial intelligence could lead to large unemployment, particularly among white collar workers. We just don't know. But that's one potential need for artificial intelligence. Now, the idea that artificial intelligence could significantly increase productivity does have historical parallels. When we see when computers were first adopted, in the early 80s, we did see quite an increase in labor productivity per hour. It, then was significantly increased with the adoption of the internet. And you can see then, as that became the standard, by all companies and workers, productivity kind of dropped down. But we see productivity kind of trending up again. And this is most likely as a result of artificial intelligence. Now, it's possible that this could lead to a complete boom in productivity and offset, baby boomer retirees, excuse me, and lead to, lower cost of production for companies that are providing a service or a product. Will that be all good? Not necessarily. There'll be winners and losers, but it's not necessarily all bad. Now, when we see the adoption of artificial intelligence, we can see, I believe, it's still in early stages. You can see in general, as of February, this is the percent of firms using artificial intelligence applications. It's only 18%. And you might get the impression that, everybody is using this. But really, it's gravitating initially towards industries where already they're very familiar with it, technology. Professional firms such as law firms, I know, are using it. Of course, finance with, data-heavy institutions are using it. Education, and then also healthcare is using it quite a lot. But there's a large, kind of swath of the economy where artificial intelligence still is kind of in its infancy. We can see in terms of what companies are, kind of spending, with a paid subscription. Now, keep in mind, you can access Claude or ChatGPT for $20 a month. So that this, may show a lot of people experimenting. But, when we think about whether companies are piloting AI agents here or have deployed, we can see some steady increase. So companies are experimenting with it, but it has yet to really create huge amount of productivity, and we'll just have to wait and see. Now, when we think about how's the stock market been responding not only to these changes in artificial intelligence, lower interest rates, concerns about employment, and then, of course, the war in Iran, we see a really interesting picture by sector. This shows the 2025 full year returns of different sectors, and technology and related technology communication firms really won the year. Although starting in late November, early December, those companies were starting to fall out of favor. And then, I think you can think of kind of the real economy, in terms of energy and consumer staples like soup and healthcare. They did well, but not nearly as well as technology. Now, when we look at up to March 20th, we could see a very different picture. Energy firms are tremendously ahead. That's not entirely unexpected with the price of commodities expected to go up. More stable, asset heavy assets or companies are doing well. And then you've got a real pullback in a number of sectors that did well last year. Many of these, I think, are driven by questions around artificial intelligence and will it not only lead to productivity, but also destroy some business models. If you're a software company and your software can easily be replicated by artificial intelligence, it's very possible your consumers will take that in-house. So, another good reason about why we like to have a well-diversified portfolio, and if you're one of our many clients who have had concentrated positions in technology companies, you've heard me say it's good to kind of trim them if they get over 8 to 10% of the portfolio. You never know what might trigger them to do poorly. And here you are, artificial intelligence is battering a number of them, and investors are rotating towards other parts of the economy. So it doesn't mean don't own technology companies. It just means own them in a well-diversified way. Now, I'll emphasize a point that I shared earlier in the year, and that is that U.S. companies are notably expensive relative to the long-term average. This dark green line shows the current valuations for U.S. companies, and that's notably above their long-term average. This metric is called price to earnings, and right now, they're trading at about 26 times a dollar of earnings. Their long-term average is 19. And so, I think it's okay to just look at that and say, wow, US is, so of course, the best performing economy in the world. It's still, I think, the best stock market in the world. And I'm not suggesting that we, dump US stocks and suddenly run towards international. But in terms of making small adjustments, I'm leaning portfolios towards international stocks, which DM called developed market, like Europe and Japan, and EM, which stands for emerging markets, like China and India. They're much more in line with their long-term historical averages. Now, this doesn't mean just because something is either expensive or, kind of in line that it'll suddenly do well. But as long-term investors, in general, it's nice to kind of take profits from what has done well US stocks, particularly US large cap growth and technology stocks, and rotate towards, the asset that, is more affordable. So it's more of a tactical shift or a leaning of a portfolio than, a wholesale shift. Now, when we look at current valuations and what does this mean for projected returns over 10 years, we can see that bonds are offering decent returns here. And so many of you, if you're a client, I have mentioned, kind of rotating back to our targets. So bonds are, providing good returns. If you look at all stocks over the next 10 years, the picture is only okay at, just shy of 5%. International stocks, both large, small, and emerging markets, look decent. But look at this. US large stocks, in particular US large cap growth stocks, are only projected to do 1.5 to 3% per year over 10 years. So again, I don't know when that might happen, but valuations do matter for investors. And then US small stocks look decent. And then a number of our diversifiers. Of course, commodities give us exposure, when things like oil prices spike. Hedge funds, managed futures, private credit, and others can provide, kind of a refuge and a different type of return. Now, those alternatives often come with a number of important considerations, such as illiquidity, potentially higher fees, delayed reporting of taxes. So it's something to consider carefully. But I think, my kind of parting words are that headlines are always screaming for our attention, and there's always something kind of to worry about it when it comes to the economy and the stock market. And this quarter is no different. The war in Iran, the Strait of Hormuz, the closing of the Strait of Hormuz, the increasing oil prices, and of course the impact of artificial intelligence, all are open questions. However, a well-diversified portfolio can handle these rotations within sectors. It can handle, drawdowns within the stock market, and so I would just say stay the course. We are paying attention to commodity prices really carefully, and we look forward to chatting with you soon. Thank you for your time, and as always, reach out to me or any of our team members if you have any questions or would like to go over this further.